Hello, everyone. Again, my name is Kevin Bielmeyer. I'm the Economic Development Director for the Town of Southbury. We appreciate you joining us and tuning in to this third webinar. This one is focused on the PPP program, the Paycheck Protection Program, and specifically focused on forgiveness. I'd like to this time introduce the guests that we have joining us for the program. We will be hearing from Dan Casanta. Dan is with Cardinal Business Financing, and Cardinal helps small and medium-sized businesses access financing, particularly when bank lending is not available. Dan and his firm have extensive experience with SBA lending, and recently, due to the strong network of SBA partners, they've been instrumental in providing millions of dollars in PPP funding to borrowers in dire need of this liquidity. And I'm sure many of you who are on this call today are folks that did receive, of course, the PPP. Joining us, we have Daniel Bedard. Dan founded his firm here in Southbury, where he also resides after working for a large regional firm and a local firm in Connecticut. Has numerous years of experience providing a wide range of services for privately held businesses in a multitude of sectors. We're very happy that he is joining us today, along with his associate, Paul Fonte. Paul joined Bedard recently in 2019. He serves as the senior manager for tax accounting and reporting services. Paul has more than 15 years of experience working closely with small and medium-sized businesses, ensuring compliance in varying business sectors, and we appreciate them joining us today, providing their expertise on this topic of the PPP forgiveness. There has been a flurry of legislation around the COVID-19 crisis. It's brought many different assistance programs and changes to tax policy that provides opportunities for savings for businesses. Some of these are straightforward, others require a discussion with your tax advisor. Today, our discussion is going to highlight the most important considerations so that you can prepare for that further discussion with your accountant. And at this time, I would like to turn the program over to Dan Casanta of Cardinal Financing, and just going to make sure he is seen. Here we go, Dan, and let me just make sure you're unmuted, because I see you are. I can't hear you yet.
How's that?
There you go.
Wonderful.
Take it away, Dan.
Kevin, thank you. Thank you for the opportunity. Thank you for the invitation, and thank you for putting on this webinar, which I think is most important to business owners, because there's so much detail, so much information out there. Much of it is unclear. And just to give everybody an overview of where this program started and where it is now, President Trump signed this into law on a Friday, March 27th, and the intent was for the program to start accepting applications the following Friday on September 3rd. Now, I'm really proud of our government for doing what they do to help small businesses and people of all sorts, but to think that we had a $359 billion program that we were going to launch effectively in 7 days was kind of a stretch. And that's where some of the ambiguities and some of the challenges came. Originally, the program was set up so that you filled out an application. Application was really based on your honesty, and also a paycheck spreadsheet, so to speak, of your payroll costs. That changed about 5 days after April 3rd, and the SBA came back and told the banks, well, we're not quite sure if we're going to guarantee all of these loans at 100%, and we're not sure if they're going to be on your balance sheet, if it's going to be an off-balance sheet or on-balance sheet transaction. So the banks looked at things and said, hey, I have no collateral, I have no personal guarantee, I don't know some of these people, we're a little nervous, and that's where things started to slow down. And the bank started to try to come up with a process where they would protect themselves and protect their balance sheet. So all that said, then you have the big banks that came in and started with hundreds of billions of dollars in loans, and then you had the bigger companies that really shouldn't have been there, got their loans. And all told and all fold, before it ran out of money, we got into or after it ran out of money, we got into the second phase. But between April 7th and May 17th, there was 27 rule changes to this program. So the reason I say all this is that it's a very complex program. It's put together very quickly. We do a lot of SBA loans, and every time we have a client that's interested in SBA lending, we always ask them, have you ever gone to the Department of Motor Vehicles and really walked away and said, I had a great experience? And generally, nobody does that. So we're dealing with the government. We're dealing with a lot of agencies here and a lot of people, a lot of administrators. So as we go through this information, there'll be a lot of questions. We're going to try to answer as many questions as we can, starting with this forgiveness, which originally didn't exist like this, but of course the forgiveness now has to be approved by the banks. And there's a lot of rules. It's 11 pages, but it's pretty well spelled out. But that's basically where we are and how we got here.
Okay, Dan, and I just put it up on the screen. You referenced it. Maybe just say a few more words about the application itself, and we'll be providing a link if anybody hasn't actually seen this on the U.S. Treasury website. We'll provide a link to this application. I know we're not going to go through it today, but just since I have it in front of everyone.
Right. And what the application really is talking about is the loan that you received as a small business owner. Were the funds spent properly in regards to the standards that were set up for forgiveness? I know Dan and Paul can speak to that more in depth than I can, but we all know that we started off with 75% of the loan had to be for payroll costs, 25% were for other costs outside of payroll, which could have been rent, mortgage, utilities, and some other things. Then we went into the situation of when does the payroll start? There was some ambiguity there. Did it start all of 2019 and take your monthly average, or do you take from February of 2019 to June? So this was part of all the changes, but this basically is laying out the information and also the questions. There's a worksheet, there's a calculation sheet that can help determine, your loan forgiveness. And Dan and Paul, correct me if I'm wrong, but I believe that if you look at their loan, if a business owner looks at his loan and there's a portion of the loan that's not forgivable, he can either keep that in the 2-year note to the bank with 1% interest, or he can give the money back, if I'm correct.
Dan, you're muted, Dan Bedard.
Yes, I would agree with that, Dan, that, you have the opportunity to repay the bank at that time that funded the loan for any amount that's not forgiven.
Okay.
What we don't know is the timing on, the bank will have 60 days from the time you submit your forgiveness application. But, timing wise, I mean, there's millions of these loans, and it'll be interesting to see how fast approval happens.
Okay, Daniel, Dan Casanta, thank you very much for that sort of introductory overview of the PPP and how we got here. And here we are. So as I said, most, if not all, of the folks that are on this call received some form of the PPP or perhaps more than one type of federal funding. Daniel, I know we've already begun, but I'm going to pass it over to you, and you want to continue the conversation.
Okay, thanks, Kevin. So I think one of the most important things here to consider is that to start gathering the information that you're going to need, there's different measurement dates, but you also need to be prepared that there's going to be significant changes ahead. Maybe not on the exact application, but we think, there's 3 different things that are up for vote. The Senate could vote this week to extend the forgiveness period to 16 weeks as one of the bills. They also have a separate bill to extend to 24 months and eliminate that 75% payroll rule. And then the House has the same bill that they're considering separately, 24 weeks for the time period, and then 75%, eliminate that 75% payroll. So I think the most right now is just, you can start the application for forgiveness, but you really can't do anything because you'll need the numbers on the measurement dates all the way through June 30th, 20 to determine your full-time equivalents. So I think that's, the big thing is be prepared for change, because what's happening is you've got restaurants that are still not open. They've received, all this PPP money, but at the same time, they laid off the employees, so they're collecting unemployment. So it wouldn't make sense to bring employees back, and because they're getting just as much probably through unemployment with the state, as well as the extra $600 federal per week. And then another thing to consider is, start working on the full-time equivalents, because that calculation, it's not going to be too difficult, but your full-time equivalent is anybody that's 40 hours or more is will be a 1, and then less than 40, you can either do the math, or you can just select that person as a half of an employee, whether they work 35 hours or 15 hours. And I think Paul will get into that in terms of why you may want that person to be just a 0.5 and not a 0.8, because you're going all the way back to the measurement periods. So I think, the application is going to take time to prepare. I think Paul and I discussed yesterday, it's probably, at least a 3 to 4 hour process for probably a company with, 10 to 15 employees. Bigger companies, it's going to be even longer time frame.
Is there a time limit to this? I would imagine there is, because, but that could be extended. I know there's been talk about it, an extension of this.
So when you say time limit to apply for forgiveness?
Well, starting there, yeah. Is there,
right.
Is there a window of time they need to get on this?
There's nothing written. The only thing that we see right now is an expiration date on the loan forgiveness application, which is October 30th. And then, the bank has 60 days from that date that you submit to approve or disapprove or adjust, the forgiveness amount.
Right. And I would think that there would be some, iteration detail on some sort of deadline for that at some point coming out.
Right. And I think, things are so fluid that even if they go down to 24 weeks, that's going to push out, all these dates even further.
Right.
Okay, thanks, Dan. I'll tell you what, this time, because I know we do have a lot of questions that we're going to get to. Let's move on to Paul. Paul, let me just have you unmute yourself and kind of pick up the conversation from here.
Hi, Kevin. Thank you very much for having us, and everyone for attending. What I wanted to talk about is what you'll encounter as you're going through this application. You'll see some new definitions. And there is a Treasury release that was May 22nd, which gives more of a narrative form as opposed to the application, which is more line by line. And it expands a bit more of what the definitions are and give examples to those definitions. What you're going to see as you're doing this application is the math works against you. And the reason I say the math works against you is because you're comparing an 8-week period, which is 56 days, to 2.5 months, which is 76 days. And that percentage is 73.8%, short of the 75% that needs to be used for payroll. So in a vacuum where every headcount was maintained, all the salaries were kept the same, there is no way without any planning that 100% of the loan can be forgiven. As it's written today, again, things are changing, talking about expanding the 8 weeks, but as it's written right now, it cannot get 100% because of that issue. By having the reduction of also having 73% over the 75, of the payroll cost, it also reduces the amount that would be the non-payroll cost, which would be 25, because the general rule is at least 75% of the forgiveness needs to come from payroll costs, and no more than 25% can come from non-payroll costs, and that's 25% not of the loan, but 25% of the total forgiveness. So, and then there's different rules in depending on entity structure. For a Schedule C with no employees, you're literally going to take your line 31 from your Schedule C, and you're going to take 15.38%, which is 8/52 of that. You could add back interest, but that has to be Schedule C interest deducted on your Schedule C. Health insurance, retirement plan would not be added onto it, because in the eyes of the Treasury, that is a personal expense as opposed to a business expense. Same rules do not apply to a S Corp or a C Corp where they're owner employees. There are limitations on how much that individual can claim as a deduction, still capped at that 15,308, which is 100,000 divided by 52 times 8. What you're also going to find is the more confusing and part of the application, all the other parts are pretty straightforward. Where you're going to get very confused is on FTE calculations and salary reductions. FTE calculations it's a numerator and denominator, and you get that quotient ratio, and then you will apply it to your payroll costs, less any salary reduction adjustments, which you'll see on worksheet A. And there's different measuring periods. So you can choose a different measuring period for the numerator and denominator. So you'll have to go through every single one of these. There's also different ways to measure. Dan alluded to it. At 40 hours, you can choose as a 1, that person being a 1 FTE, or a 0.5 if they work less than 40 hours. But you'll have to look at your census of your employees, because if you have a lot of employees that work less than 20 hours, the 0.5 is detrimental. Because less than 20 would give you a ratio over 40 of less than 0.5. So you want to get your denominator as low as possible. So that might not be the method you use. So you'll have to run all these scenarios and determine which methods, which measurement periods are optimal for you. So you'll have to run through them all. And Dan also alluded to the fact of the application doesn't technically have a due date. It doesn't. And the reason we have some initial people whose 8 weeks might be coming up at the end of this week, some of the initial people, borrowers. They have a safe harbor that goes out to June 30th. So if you can restore your head count back to June 30th, there's a safe harbor where you don't have to reduce. Same on the salary reductions. If there's a salary reduction, you have until June 30th or earlier to restore those values so that you can qualify for the safe harbor and not have to deal with it. Now, you still need the payroll costs. So, if individuals were laid off, that would obviously be a problem because we don't have the payroll costs. There are two very big things that happened within that 522 Treasury release. And one, it talked about what if I offered someone a job and they turned me down? Does it impact my FTE calculation and my reduction to payroll calculation? They have come out and said it does not. But what we have to do is document that the job was offered to them, it was turned down. If we know that they're claiming unemployment, and that puts us in a position that if we don't want it to affect our FTE, within 30 days of that reduction of not taking the job, we notify in our state the unemployment department that they have rejected a job. And Treasury Secretary Mnuchin has come out and said, that is unemployment fraud, and hasn't said exactly how they would deal with it, but that is something that now puts the onus on the borrower to consider as they're doing this application.
Okay, yeah, there's a lot of variables, no doubt. I think one overarching, and I kind of mentioned at the beginning, is because there's so much involved in this, it's not advised to tackle this alone. That you definitely should get whoever works with you on your taxes, whether it's tax attorney, CPA, et cetera, but somebody who you work with on a professional level to help you go through this and make sure that you're doing it correctly.
I agree. Can I just put one point on that? When you do fill out the application, it would benefit to have a second set of eyes on it, because when you are completing the application, there is a certification that you are providing accurate, truthful information. So, you don't want to have to deal with, and it goes in through the penalties of fraud, and so that's something, maybe a second set of eyes wouldn't be a bad thing to have.
Absolutely. And just to also be clear, when the forgiveness is applied for, essentially the money that the clients, the businesses have received, is money that has been paid to them through their lender. And the idea of the forgiveness is getting the SBA to approve the forgiveness and thereby cut checks essentially to your lending institution for the forgiveness amount, and then your lender can pass on that forgiveness to the business. Is that accurate?
That's correct. The SBA is reimbursing the banks, both the accrued interest. What they do is the part that is forgiven, the accrued interest continues, starts counting on the day you get your PPP money. So when they are reimbursed, they determine a forgiveness amount, the bank gets both the forgiveness amount and the accrued interest on that forgiveness amount. And then they term out the rest of that loan to the individual, and the banks carry the debt on their books. It is their debt. And that has some backstops from SBA if there's some issues. But it is on their books, and it becomes the accrued interest, and the payments are then due, because there's a 6 months deferral payment for deferral on all payments and interest. Then it'll be termed out for the next 18 months, both the principal that's not forgiven, the accrued interest on the part that's not forgiven, and then they term it out at 18 months at 1%.
Okay. So at this point, unless any of my guests have more they want to interject or add at this point, we can go to questions. Let me just check with the panelists. Panelists?
Good with questions.
Absolutely.
Okay.
Yep.
So
good.
there were talking to our participants on the line. There were many questions that were pre-submitted upon application for the registration for this webinar. In addition to that, if you haven't already discovered it, participants, on the right-hand side of your screen or somewhere in there, you should see a little question mark. It's a live event Q&A, and it allows you to type in questions on the fly. So I have received some of those too, and we will try to get to everything. So some of these questions may have been answered in your descriptions, I'm sure, but it doesn't hurt to reiterate some of these anyway. So one question: are owner salaries considered part of the 75% payroll expense to be eligible for forgiveness? If less than 75% is used for payroll, then how much is eligible for forgiveness? What if, and I guess the third question of this part is, what if you can't pay it back within the 2 years? Who would like to jump in on that?
I would take that. Yep, I'll take that. Yeah. So yes, officers' wages are part of the 75. I'm assuming he's saying officer salaries, so he's either a S corporation or a C corp. So the limitations on that are 15.38% of the lesser of those paid within the 8-week covered period or alternative covered period, or 15.38% of 2019's annualized level. So you cannot give yourself a bonus or a raise and get it counted towards PPP forgiveness. You can give yourself a raise, it just doesn't count towards getting it forgiven. If you do not meet the 75% payroll, well, then there's a reduction, it's a calculation. You calculate what your total payroll costs are over that 75%, and you'll get a ratio. So I can give a quick example. If you had a $100,000 loan and you only used 50,000 for payroll costs, that would be 66%, and you would get that 50 over 75, which was the minimum required. But then you would have to take that 66% and also apply it to the 25%. So that would be limited. Say you had $25,000, That now would be capped at 16,500, would be the 66% of the 25%. So in total, in this case, if you had a $100,000 loan, we had $50,000 of payroll, so that's only 66% of the 75. The max that you could get forgiven would be 66,500 of the $100,000 loan. So the rest would have to be paid back, again, deferred for the first 6 months, and then termed out 18 at 1%. If you cannot pay it back, the bank has all the rights it has in any of its other loan. You've given it a personal guarantee when you signed the loan. There was a closing document, and you signed some personal guarantees, and they can go through all means necessary to available to them to capture that money.
Okay, good. Thank you. And I know you mentioned the deferment and the 1% interest. Is there? Do we know if there's a prepayment penalty for the loan?
There is not. You can pay it whenever you want. Like I said, their only issue is like a part that is not forgiven. It could continue to accrue interest at 1% from the day you received it. So there will be wouldn't be just the principal portion that you would have to pay back. There would be a little bit of interest. Now at 1% for 6 months, it wouldn't be a ton of money, but you could just pay it all then and not have to term it out. But at 18 months, 1%, and most people would be inclined to just term it out. And that interest would be, a legitimate business deduction.
Yeah, I think too, just to add to that though, if you're looking at a small business, and let's say $40,000 of that loan is not forgiven, you're taking $40,000, and correct me if I'm right, Paul, but you're taking $40,000 plus 1% interest and dividing it by basically 18 for a monthly payment.
Correct.
Which is a pretty darn good chunk of money for a small business to add $2,000 plus a month to their costs. So the key obviously is to be very careful on how you did apply and how you're using the funds so you don't get caught with that obligation.
Correct. Yeah.
Agreed.
Okay, another question. If we funded our PPP May 1st, doesn't the alternate payroll language mean that if we are closed and don't run a payroll until July 3rd, then our 8-week clock starts July 3rd, which begins on the first day of the first payroll period following the loan disbursement date? So there seems to be, it's definitely a date question. When does the clock start ticking?
I could take that question.
Sure.
So it does, the alternative period does allow you to choose something different than the counting from the 56 days counting from the first day you get your money. However, it does not, at least it is not clear that if you're closed, it waits until the next payroll. What it says is you can pick an alternative payroll that is bi-weekly or sooner. So say you've got your money in the middle of one of your bi-weekly. So one of the weeks already passed, you've got your next one. You could either start counting from the first day you got it, or you can count when the next payroll, the first payroll gets paid. So we would count it on the following week and then go 8 weeks from then. There is some back and forth of if the alternative method is actually a better method if you're on a bi-weekly, because if you're on a bi-weekly and you got your money in the middle of the week, it is paid and incurred payroll. So you can technically get actually 9 weeks because you would get 1 week of the week before because it'd be when you paid it. You've already passed 1 week of the bi-weekly. You're going to pay it in the next week, which would be your first week of your normal covered period. And then you're going to also have on the back end an incurred week. So it could equal 9. However, if the individual is over $100,000, box 1 of worksheet, table 1 of the worksheet says no number in there can be greater than $15,385. So if it's someone that's making less than $100,000, there is the potential where you can have technically 9 weeks as your covered period if you use the covered period as opposed to the alternative method.
Okay. This person says that they're still waiting. It's really more of a statement, but if you have some insight, they're still awaiting the SBA's detailed definition of utilities and transportation expenses that are covered under the 25% forgiveness portion. Do you know anything more about that?
I think go ahead, Paul, but I still think that's a very gray area in terms of explanation by the SBA. We've had discussions on this, but Paul, what's your thoughts on that?
So they aren't exactly clear on what exactly is utilities. What they essentially say is it is distribution of electricity, gas, water, transportation, which is the big sticking point, telephone and internet access. That is utility and transportation. Now, I've seen discussion on the transportation, but the SBA hasn't exactly said it. But if I were to venture a guess what transportation would be something in the neighborhood of mileage reimbursement to an employee. If you have an accountable plan, they have train tickets, or it probably, given that travel was restricted, aren't going to have many as in travel expenses, but also gas. That's what you're going to be looking at transportation, but they haven't been very clear on it. The Treasury has been a little bit less clear on the 25%. Because they give you the ability to prepay rent, they give you the ability to prepay utilities. It's also paid or incurred, so you might not technically pay. If your covered period ends on the 30th, but you have 15 days of a utility bill on there, you can take 15 of the next pay, as long as you pay it within the next billing cycle. So they've been a little lenient in not going far into it. It's because they feel that it can't be really abused to an extent because of the limitations of the 25%. Because we go to prepaying rent, well, as accountants, the first thing that pops into my head is what happens with a self-rental. Can I prepay a full year's worth? And I could see that being too aggressive a position, but they haven't been clear on it. But at this point, they haven't been really kind of rigid on it because they feel that the 25 it makes it de minimis the amount of people that could be very aggressive in that area.
Paul, on the transportation, I just want to add in, I have clients that have asked me several times about, does transportation mean the lease payment or the loan payment to my automobile that my company is paying for? My feeling has always been, I doubt it. Not being an expert like the CPAs, but I would not think the Treasury Department would be wanting to include loan payments or lease payments in that.
Correct. The way they term loan payments is long-term debt. So you'll have to look at trucks, and if it's you have a truck that you lease, now you have to look at the character of the lease. So it brings in some accounting terms. Is it an operating lease? Is it a capitalized lease? A capitalized lease, it's your asset. You have an interest portion of it and a principal portion of it that you pay every month. Where if it's an operating lease, all you're doing is renting it. Now, could that potentially be part of the rent? Still hasn't been exactly nailed down on the autos. But it does say it could be personal property on rent, not just real estate, as long as there's a business use of it. But again, on those payments, on interest, it's just the interest, not the principal portion of it. That would be counted.
Okay. How can the 8-week term truly be forgivable when a business is shut down? How can I compete with the extra $600 that folks are getting in their paychecks from the federal government and potentially put myself into debt?
And I think that's, my first point when I spoke was, it's probably why we're going to get some kind of extension of 16 weeks or 24 weeks, because the whole $600 extra per week kind of threw a wrench in the whole process. And, it was more advantageous for people to do that than it was to keep people on payroll, especially a closed business that wasn't doing anything. So whether it's, a dental office or, a restaurant. So again, right now it is 8 weeks, but, I think the chances are pretty good that, it'll go to 16 or 24 weeks.
Yeah, I think there's going to be more guidance coming out in the next probably 2 to 3 weeks that are going to clear up some of these questions as well.
Yeah, the Restaurant Association had met with the White House, and that was one of their biggest sticking points of how we were not open. Now, the Treasury Secretary and the White House have pushed back and said, well, the point of the PPP was to maintain the headcount and what you were paying, whether you were open or not, so that people would not go on unemployment. However, then they put out the $600, which maybe enticed some individuals and for some employers to look at it and say, wait a minute, you'll actually make more money if you're unemployed than if I were paying you through the PPP. So that one's just that one's a tough sticking point. And you know, none of this legislation happens in a vacuum. If they remove the 75%, then now they must put some more stringent rules in place on the 25%. The non-payroll costs, because now it would lead to significant abuses that could potentially come into play. So nothing happens in a vacuum. If they make changes, there are going to be significant other changes that have to remedy the holes it will create.
Yeah, something I remember when they were first introducing the PPP related to this, and a lot of folks that I talked to who brought this up. One of the things that was made clear, is that they do not have to rehire the same employees. They don't even necessarily have to have the same count of employees if it's really just the overall payroll cost. So if they had 8 employees at a certain rate and those 8 didn't want to come back, but they wanted to hire 5, but they were spending as, you know, giving them a raise to come back, you know, if they felt they were worried about working, whatever way they want to slice it, as long as your payroll costs are the same. That's my understanding as I heard it in the beginning. Does that sound accurate to you?
But you still have to deal with the full-time equivalent numbers, though. So it's the dollars, but just as important as that full-time equivalent number to maintain, you know, payroll in order to get the forgiveness.
Right.
Okay, yeah. So it can't be like a few part-time folks kind of being added up to come to those full-time payroll costs, you're saying?
You can, if you can get the figure back up to that to meet your denominator. If you add, you know, twice as many part-timers, that would count as 0.5s. You know, every 2 counts as 1 of your previous. You know, if you get enough numbers, then it could work. So the problem with what would happen, and sometimes there are clarifications, it's coming too late after the fact. There is planning that could have been done, but now, I mean, we're having individuals that their 8 weeks are running out at the end of this week. They can't really plan anymore. You look at a sole proprietor who cannot get 100% forgiveness. Well, there's a planning strategy where we could have legitimately hired, maybe a spouse or a child. You know, again, meaning they work and they meet the fair labor standards for their age. We could have gotten them on payroll and got us that 100%. They have no problem hiring individuals. They actually would be very thrilled if you hired more individuals. And that is how it would help boost up the payroll costs and keep individuals off of unemployment, as the plan initially was. So FTE came in a little bit after the fact. It was initially just, hey, what if you continue to use the payroll? But then they realized, hey, what would happen is individuals will give their prime employees significant increases, and maybe some employees that are, you know, people they can replace, they might let them go. And they didn't want to benefit some classes opposed to others, you know, some other positions.
Gotcha. Okay, this person asked, when applying for the PPP loan, we were supposed to cap any employees making $100,000 at $100,000 for loan calculation purposes. Does that mean that we are only allowed to pay such employees $19.23 per week for the 8 weeks, or can we compensate them more and have the difference forgiven, or even compensate them more and have the total amount forgiven? I'm just confused how the PPP works for high-income employees.
So 100,000 is the maximum that you can apply to. So it's, you know, I think the number is 15,384, Paul.
Yeah.
You know, or 19.23 a week for the 8 weeks. But doesn't mean you can't pay somebody more than that. It's just that when you go to worksheet 2, that it's going to eliminate any amounts over the 15,384. But, you know, you're still allowed to pay more, but there'll be no forgiveness on any amount in excess of $15,384.
Okay. So this person says, I understand that as long as a loan is used to retain or avoid layoffs of employees during COVID-19 restrictions, businesses have met their primary hurdle for forgiveness. The second hurdle is calculating the amount claimed as the payroll expense, which should not include payments to contractors, subcontractors, or 1099 services. Payroll expense should include payments for, this is again, they're really stating this, should include payments for sick leave, vacation, or other paid leave due to the shutdown. Can payroll for employees or employee who does not return to work due to concern about transmission in absence of symptoms, diagnosis, or other indicators of need for quarantine after their job is open, affect inclusion for forgiveness of the loan?
I'll take that. So yes, they will. So they'll be part of the reference period, your denominator calculation of the full-time equivalency. Now, if they do not come back and it's on their own, not come back, even if someone is fired for cause, you would have to document it and go through all the procedures so that then you would count them as if they were employed. Now, you haven't paid them, so you've now got an issue of not having payroll costs. So you would either have to hire someone else to take his position, but if you hire someone to take his position, then that person probably equates to his full-time equivalency, and you don't even have to include them in that calculation. There's a little bit of an interchange on that. And I also just wanted to say one big point is because we're talking about two potential reductions, one on the full-time equivalency and the other on reduced wages. You do not get punished for the same person as long as so say you have a reduction in wages, and part of it, what drives that reduction is the reduction in hours, not the reduction in pay rate. So you do not get double punished. Say you have someone who was making $1,000 a week and now they're making $500 because their hours went from 40 to 20. Their rate remained the same. What changed was the amount of hours they worked. So you'll get penalized for that individual on the full-time equivalency, but I will not have to include the reduction of his wages, average wages, as a reduction for the over 25%. They just don't. The Treasury allows, so they do want to hit you with a double penalty for the same problem. But if you had a reduction of time and rate, then you'd have to segregate what is time and what is a reduction of rate. And it goes into that one's quite a large calculation with different measuring points because there's different safe harbors. That if you could restore someone or at a certain period, it would stop you from having to do that calculation. That's the part of it that might get a little confusing.
Okay.
So I also think just as another.
Back to you, Dan.
So the last part of that question, I believe the question relates to the paid leave, the new Paid Leave Act, the Family First Coronavirus Response Act. But these symptoms, this person, absence of symptoms, diagnosis, wouldn't qualify. You'd have to, if they're working, you'd pay them. But if the person qualifies for the Family First Act, then you have to exclude those wages from the forgiveness calculation because the federal government is subsidizing those wages.
Right.
Okay, I see what you're saying. Yeah, so I guess the question is whether they are excluded or not, whether they are getting that benefit or not.
Correct.
It affects us. Question 7 was, I've heard discussion on certain benefits which may or may not be included, such as non-taxable health insurance premiums, health savings, non-taxable retirement savings, and other non-taxable benefits, child care savings, and the like. What about employees and or employers' share of Social Security?
That's not includable as a payroll cost. The only tax, if you're from Connecticut, that's really going to apply would be your state unemployment tax, the SUTA tax, that you would include in your calculation for payroll.
And what the individual might be alluding to is, if they have a Section 125 plan, we're deducting the health insurance, HSA contribution, maybe an FSA on a dependent care. Do I get the reduced number because that would be my box 1 income? And it's not. What they do is they calculate as gross income. The limitations on the health insurance for an employer, what do I include as my health cost? It'd be my health cost that I pay. So if an individual's health cost per month is $1,000 and they themselves contribute $500, I can only include $500 because as an employer, my portion is $500 for that employee.
Okay, what is the date which employees have to be employed to qualify for inclusion? Does this apply to specific employee or positions? There's kind of multiple questions here. If the business was in the process of hiring and had offered positions which were vacant from January to the start of April 1st, which is what they believe is after the date stated in the CARES Act, that it would pay the amount for this employee to be included. Would facts that he was or wasn't able to start due to COVID-19 rules affect the decision?
No, it wouldn't. So if that individual was offered a job but didn't take the job, obviously given what happened, he would not be included in the reference period, which would be the denominator. Denominator is measured of one of two ways: February 15th, January 19th to June 30th, 2019. That's one measuring point, or January 1st, 2020 to February 29th, 2020. And then there's two ways of measuring within those two measuring periods. So that individual who was offered a job in 2020 but did not take a job would not appear in the reference period, and then he would not appear in the covered period because he is not part of the payroll costs.
However, if that person starts on April 1, they would be included in the payroll.
Correct. If they started up, yeah.
They'd qualify, if they were full-time, they would qualify as one of the FTEs.
And they would be actually extremely beneficial because they're not in the reference period, the denominator, and they are in the numerator, thereby helping you, not having to deal with the FTE because now you have a better ratio.
Okay, if rent and utilities were not used for the initial calculation of the PPP loan, should it be included in the forgiveness request?
Take that. Yes, it'll be included. It'll be part of that non-payroll cost. It'll be limited to 25%. The way they calculated the PPP, it was solely based on payroll, as the program is a Paycheck protection program. Had nothing to do with the 25. The 25, I think, might have been thrown in is they found that the ratio came out to close to 75, so they needed a 25 kicker to get 100%, and that's how that 25 might have come in. And then they said, okay, well, what are the things that are valuable to us as a nation? Well, we want to make sure our utilities are funded. We want to make sure our mortgage debts, that we're not having another mortgage crisis where debt might be a problem. So they sort of prioritize what would they allow within that 25%. So yes, utilities, though not in part of the calculation, is part of the forgiveness through that 25, but that 25 is limited to 25% of the total forgiveness. So if you didn't use 75% of as payroll costs, you would then also have to reduce the portion of the 25% as well, based on that ratio.
Gotcha. Now, if the loan is to cover 8 weeks, and I think that we kind of covered this, but I'll just re-ask it. If the loan is to cover 8 weeks, why is the month amount times 2.5?
It's a good question. I think the 2.5 might have been in the back of the Treasury's mind that we'd be reopened by May 1st. So it would take us February 15th to May 1st. I think that was their initial kind of concept to it. So they would be able to carry the average payroll for the next 2.5 months until we're finally reopened and at our full strength. Things obviously didn't pan out exactly that way. So I think that might be why they're a little bit more considerate of the numerator now as well, because the numerator didn't come to fruition.
Yeah. What are the requirements, timeline, spending, documentation? This is kind of probably a loaded question for reporting the use of the PPP loan funds. A lot to come up with there, right?
There's a lot of documentation in the loan forgiveness application. It lists a lot of the documentation. Some documentation you have to submit. Other documentation you just have to keep for a number of years. And the SBA has so many years that they can come back and look at, all your documentation beyond the bank approving it.
Correct. So they've made it a little bit of expedient, the documentation that is required to a bank, because they've understood that if they really put it to the banks to gather all this information and verify it and go through it, they would find it very tough to meet their 60-day obligation for decision, and two, just the manpower and technology power to go through all this. The SBA has put a 6-year window, kind of like a statute of limitations on when they can come back and ask for documents. It's a 6 on the lender. They must maintain their documents for 6 years, and it's 6 years for us. And it's both a 6-year from for the forgiveness, when the forgiveness is picked, or 6 years from when the given loan is paid off. So, and at any time they could ask for the documentation. Most of the worksheet application calculations and stuff is not requested, but we have to hold on to it. The parts that only parts you're giving to the bank are the application, page 1, and Schedule A. Your worksheets that you use to prepare those are not provided to the banks.
Okay, and that probably answers this last question of the pre-questions. Who will we report to? The bank who funded us, our lender, or to the SBA?
Generally to the bank. The forgiveness is basically in the hands of the bank, and those will be made by the bank on a case-by-case basis. I also think too, when you go back to the keeping of documents, that anybody that is in that $2 million, am I right, guys? $2 million and above, more than likely will be audited. But I don't know about criminal activity, but I think most of the resolution, if there is something wrong with those types of loans that are audited, will just be basically pay the money back. I mean, they don't want to get into litigation and all the other stuff that goes with it, but you are responsible for paying if it's calculated inappropriately.
Correct. The only issues that would maybe come with severe penalties would be fraud. Right. If it was applied under fraud, and then fraud could be proved.
Okay, so that is all for the pre-sent in questions. If you sent in a question and you haven't heard it, apologize. It may have just been too close to the start of our webinar. So I'm jumping over to the questions that came in on the fly. This one is, are lease payments for trucks covered under the eligible non-payroll costs for lease payments for real or personal property?
I think I had sort of talked about this before. It depends on the nature of the lease. Is it a capital lease, or is it an operating lease? An operating lease is, you don't own the car, you're essentially renting it. There hasn't been any discussion of lease payments if they qualify for the rent portion of the non-payroll cost forgiveness portion. But they do talk about tangible property. So it could be safe to say if it's necessary for, if you're a construction company and you're leasing a dump truck, I mean, it's conducive to your business. If you're leasing a personal use auto, I maybe say that might be a little bit more questionable. It depends on the nature and it depends on the character. And then if it's a capital lease, it's just via straight finance lease. It would look exactly the same. So there'd be an interest component of it, and that would be included. Now, credit card interest, that is not. Has to be long-term debt. Long-term debt, and these debts need to have been in place on February 15th, 2020. You can't get it after the fact. So you can't have gone out and leased a car or signed a lease agreement after the fact.
Okay, and a couple of these also were answered internally with the chat box, but Dan Bedard, I'll have you answer this one. If our normal work week is 37.5 hours, would our FTE still be a 1?
No, it's going to be, the ratio of 37.5 over 40. But again, that person would be able to decide to use 0.5 in terms of measurement period, which may actually help them. Yeah. But they have to be consistent with that on the forgiveness application, also counting those people as 0.5, unless you, increase their hours to 40 hours a week.
Correct. So whatever method you use. So whatever method you use for the denominator, if you're using the 1 and the 0.5, then you'd have to apply that same calculation method to your numerator which would be your covered period or your alternative covered period, you would have to treat all those individuals as a 1 or a 0.5. You know, if you have a lot of employees that are 30 hours, 35 hours, the 0.5 might be beneficial because you're getting your denominator down lower. But then you would have to look at what effect does that have on my numerator and the ratio. So you have to run it in both manners and then decide on which one is the best for your situation, because every situation is different. Every entity is different. They're treated slightly differently.
So I've been paying a bookkeeper for 32 hours. How will that affect the forgiveness?
Well, it depends on how that bookkeeper, is she an employee of yours or is she a subcontractor? If she is a subcontractor, there is nothing. It doesn't apply in any way in your forgiveness. She actually applies for her own PPP loan, and then she has her own things that she has to deal with. But if she's I'm assuming a independent contractor, they wouldn't count as your payroll costs, nor count as your FTEs or anything.
I have read that there is the ability to accrue hours worked during the end of the 8-week period, but will not be paid to employees until after the 8-week period, and include this pay in the 8-week period for forgiveness. Is this true?
That is correct. It's called incurred payments. So like I think I might have given an example previously. If you were bi-weekly and you got your money right in between each of the weeks, you would then pay the following week the 2 weeks that were from the other. So you're actually bringing in a week that was prior to a measuring period because it's paid or incurred. But once you got to the end, you will also have 1 week to which it hasn't been yet paid, but you could incur. So you could take 1/2, bi-weekly, you can take half of that and still include it. But there's still the overriding of the $15,385. So if that individual in that calculation gets them over $15,385, you're still capped at $15,385. If they're an individual who makes under $100,000, then there might be a benefit of picking a covered period as opposed to an alternative covered period. Because the covered alternative period, it will be just 56 days because you're starting from a payroll period and ending on a payroll period.
If you don't use the PPP loan for payroll, can you still use it for utilities? Also, if you get reduced, does the 25% get reduced?
Yes. So 75% has to come from the payroll. If you had 0 payroll costs, that would be 0%. So if 0% is coming from payroll, then 0% comes from 25, whether you have them or not. You would have to apply that same ratio because the general rule is at least 75 has to come from payroll and no more than 25% can come from the non-payroll. So you still got to keep that 75-25 ratio.
So if there's 0 payroll, Paul, what you're saying is that there's 0 forgiveness?
0 forgiveness, correct.
Okay.
Okay, this one might be a little too detailed for the moment, and I will say that all the ones that we don't get to, because we are at an hour here, we will provide answers to directly to those that ask these questions. But my payroll provider supplied a report that showed 6 FTE based on I don't know if you guys can see this question or not. So must be January 1st, 20 to February 29th, 20. No one worked 40 hours. Actual hours average 25. In current period, we are paying at the same number of hours, 25, and the payroll provider calculates as 6 FTE. How do we report this on forgiveness? And feel free to let me have this, wait if we need a more deeper look at it.
So the 1/1/20 to February 29/20, that's your base period, your denominator for the FTE calculation. So if you continue to have the same mix in payroll, you're not going to have to deal with the full-time equivalent. You're not going to have to deal with any reduction in pay because it's exactly the same. You will just put the quotient as 1 on the front on Schedule A. You would put the quotient of 1 so that there is no reduction. There is going to be on Table 1. I'm assuming everyone makes under $100,000. On Table 1, you would not have to deal with the reduction because there is no reduction. So essentially, it would meet the safe harbor given that specific scenario.
Let's just take one more because of time. If a full-time employee was hired late in reference period, are they counted as a full-time employee, one, or can they be prorated?
That one sort of depends which method you're using, for one, because what they do is it's the full-time equivalency of the measuring period. So you have to get the average hours for that period. Now, if that individual is coming in late in the reference period, they're going to have very little weight on the FTE calculation, because it'll be, it'll say it's the 12-week period. It would be just 1 week over 12. So he would be a very minimal, be about a 0.1 or 0.2, depending on how many hours.
All right. I want to be cognizant of everybody's time, both my guests participating today, but also those that have joined us to watch this webinar, because we are just past 1 o'clock. Again, I want to thank my guests who joined me today, Dan Casanta from Cardinal Financing. Dan, we appreciate your time today, and want to draw everybody's attention just for a second to learn more about Cardinal Business Financing here on the web, which is right here at cardinalbusinessfinancing.com. And then we have Bedard and Company Certified Public Accountants. This is your page here, and let me see here. Oh, actually, we weren't live. There it is. Okay. Just for folks who want to get in touch with Paul or Dan, they can go there. Or another option is I'm going to be sending out this this one pager. Hang on a second. I will be sending out this after we are done here. And this has everybody's contact information and some of the links to some of the helpful things like the application and some FAQs and some other information is all going to be on this one sheet that I'm going to send out to everybody that joined us for today's call.
Kevin, can I add a comment there?
You sure may. There you go.
There's
Dan.
still $150 billion left on this program that's been unused for a variety of reasons. Any inquiries that we get here at Cardinal, the first thing we tell those inquiries are to go to your local bank first, see if your local bank is still making loans. If they're not, or if you have a Chase Bank or a big bank, make sure you just have a contact person if they do take your application. Or if you can't find the bank, you can go to sba.gov and it'll give you a listing of local banks that are still working with the PPP program, but there's still money left, opportunities for those that haven't done it yet.
That's great. Great to remind everyone, Dan. I know the first go around got evaporated pretty darn quick, and we were all very pleased when they issued the second wave. But as you said, it's not completely exhausted. So if you have not taken advantage of this opportunity, be sure to do so. Again, thanks to Paul, thanks to Dan for joining me, and thanks to all of you. And this webinar will be available on our Southbury webinar website to watch afterwards. And we're also going to be sending out a link to that to all of our participants if you were unable to join us for the entire call. So thank you very much, and have a great day.
Thank you.
Thank you, Kevin. Y'all take care.
Bye-bye now.
Bye-bye.